Back in 2007, growth stocks were 3 times as expensive as value. Summer of 2020, it had widened to 9 times. That means value had gotten threefold cheaper in the space of those 13 years relative to growth stocks. That spread of 9 to 1 was actually wider than at the top of the dot-com bubble. Now, value underperformed. If you look at Russell value versus the market, it underperformed by 38%. But if you're getting cheaper by 2/3 and you're underperforming by 38%, it means that if the relative valuation had remained where it was, value would have outperformed. So in fact, the value effect is alive and well. I wrote a paper in the Financial Analyst Journal in 2021, Reports of Value's Death Have Been Greatly Exaggerated, in which I looked at the attribution and found that the entire drawdown for value came not because value companies were struggling, not because the value investing was a bad idea, but because value investing was falling out of favor and getting cheaper.
So you pioneered what's referred to as the fundamental index, which has been this really unique approach to indexing that adds alpha by really adding more of a value tilt to it, is the way I see it. So how about you talk about what the fundamental index is and how it's performed since you launched the strategy?
Sure. The genesis for the strategy was the aftermath of the dot-com bubble. A dear friend of mine who ran a company called the Common Fund that managed commingled university endowments. He also served on the New York State Pension Board and several other boards. And he was just beside himself. He was very distressed because money was pouring into index funds, and index funds had a 4% position in Cisco at a time when Cisco was a tiny company, and that subsequently went down 90%. You had the whole dot-com suite of companies down, NASDAQ was down 80% in that bear market. And so it was the crash of the dot-com bubble. He came to me and he said, there's got to be a better way. I had long thought that indexing by market cap is a great way to match the market because the market is cap weighted, but is on one level a not so clever way to invest because any stock that's overvalued relative to its future prospects is going to be overweight in the portfolio relative to a fair value weighting. Any stock that's undervalued, destined to outperform, is going to be underweight because you're tying the weight to the price. Now, indexers have heard that criticism since the launch of the S&P back in 1957, and they always had a ready retort to that. They said, of course we overweight the overvalued and underweight the undervalued. But unless you can tell me which is which, you haven't said anything useful. Well, it turns out that acknowledging that you're overweight the overvalued and underweight the undervalued, and doing so because you're tying the weight to the price, if the price doubles, your weight doubles, that there's a missed opportunity there. One of the originators of the capital asset pricing model, Jack Traynor, who was a dear friend, wrote a paper in the Financial Analyst Journal, Why Valuation Indifferent Indexes Work, and it was inspired by Fundamental Index. He pointed out that you don't know if stocks are over or undervalued. Fair enough. But you do know that some are overvalued and some are undervalued. You do know that with cap weighting, you're overweight the overvalued and underweight the undervalued. Take any other weighting scheme, if it ignores price, if it ignores market cap, a stock that's overvalued might be over or underweight. A stock that's undervalued might be over or underweight. And the result is that the errors cancel instead of magnifying. And he also pointed out that the price action of a stock, stocks can come into favor, and if the fundamentals don't match the price appreciation, then watch out, there could be mean reversion. The market's constantly changing its mind on what a company's worth. So a stable anchor, like the size of its business, will lead to a rebalancing alpha. And that's the cool part. It does have a value tilt. Growth stocks are de-emphasized down to their economic footprint. Value stocks are re-emphasized up to theirs. I mean, Chevron's a huge company, but it's not huge market cap. Nvidia is a big company, but it's not an enormous company. And it's priced as if it's truly spectacularly enormous. Current pricing is about 30 times sales. Scott McNally from Sun Microsystems back in 2002 was questioned by Congress about his stock having cratered. And his comment was, we were priced at over 10 times sales. If business is steady, that means we have to deliver 100% of the total revenues of the company in dividends to shareholders over the next 10 years to justify the price. And that assumes that the company has no expenses, that the shareholders are paying no taxes. He said it's preposterous for a company to be 10 times sales. What were the investors thinking? And he was actually vocal in 99 and 2000 that his stock was way overpriced. Currently, you have Nvidia at 30 times sales. Is that justified? If it's got stupendous growth over the coming decade, if 10 years from now it's going to be 30 times its current size, then maybe. But absent that, it does make sense to weight it lower. So with fundamental index, an idea I'd been playing with for in the back of my mind for at least a decade was, why not weight companies by their sales? Why not weight them by their book value? And so we tested a whole array of measures: sales, profits, cash flow, EBITDA, book value, dividends, number of employees, where McDonald's would be one of your largest holdings. It didn't matter which measure you used. We found it added about 2% per annum. It did introduce a value tilt, because if you're weighting companies on their fundamental size, you're de-emphasizing growth, you're re-emphasizing value. Now, these are better companies, for sure, but it's in the price. The market's already priced in the quality of the business, and unless it exceeds lofty expectations, it's not going to help you. The value stocks, troubled companies with headwinds, it's not going to hurt you unless it underperforms bleak expectations. So it does have a value tilt, and the result is that when you compare it with the cap-weighted market, fundamental index wins over long periods of time by about 2% a year. If you compare it with value indexes that are cap-weighted and therefore overweight the overpriced value stocks and underweight the underpriced value stocks, you get the same drag from the cap-weighted version. And so relative to value indexes, we find that the outperformance is relentless. In the U.S. in the last 17 years, RAFI would have beat the Russell Value Index 14 out of 17 times. The global index against MSCI Acqui Value outperforms in 15 out of 17 years. I mean, that's astonishing consistency. And it all comes about not because of the value tilt. The value tilt is a consequence of fundamental weighting. And yes, value does have a little bit of an alpha, but the big alpha comes from rebalancing, from concentrating against the market's constantly changing opinions.
Yeah, and since you mentioned Nvidia, I just looked up what their weighting was in the S&P 500, and it's 6.25%. So anyone that's buying that index today is putting a 6.25% of that, say $100 into Nvidia. And I think most people would assume that a strategy like this has underperformed, at least in recent years, because this sort of strategy would have been underweight many of the biggest companies in the S&P 500. So how would you explain what is compensated for being underweight the bigger winners?
Well, if you look back, value peaked in 2007. And it hit bottom in the summer of 2020. It bottom bounced again at the end of 21. It's bottom bouncing again now. What do I mean by bottom bouncing? The relative cheapness of value. Back in 2007, growth stocks were 3 times as expensive as value. Summer of 2020, it had widened to 9 times. That means value had gotten threefold cheaper in the space of those 13 years relative to growth stocks. That spread of 9 to 1 was actually wider than at the top of the dot-com bubble. Now, value underperformed. If you look at Russell value versus the market, it underperformed by 38%. But if you're getting cheaper by 2/3 and you're underperforming by 38%, it means that if the relative valuation had remained where it was, value would have outperformed. So in fact, the value effect is alive and well. I wrote a paper in the Financial Analyst Journal in 2021, Reports of Value's Death Have Been Greatly Exaggerated, in which I looked at the attribution and found that the entire drawdown for value came not because value companies were struggling, not because the value investing was a bad idea, but because value investing was falling out of favor and getting cheaper. When value is melting down to that extent, no, RAFI will not beat the broad market, but it beat value handily. And the result is, from 2007 to today, RAFI has roughly kept pace with the broad market. Similar return to the S&P 500, similar return to the Russell 1000, but anchoring on value stocks, which are now dirt cheap. So to the extent anyone believes value deserves a place in their portfolio, why would you invest in value any other way than fundamental index? The relative performance versus value is relentless. The relative performance against the broad market is more iffy. When value is winning, boy, do we win handily, big time. When value is losing, we have headwinds and we often will underperform. The aftermath of the global financial crisis, value staged a nice comeback in the middle 2 quarters of 2009 and then started to sputter. Value, therefore, roughly matched the stock market in the year 2009, underperforming big in the first quarter, then outperforming, then underperforming, finishing right about in line with the market. How did RAFI do? As value was tanking, we went to a deeper and deeper and deeper value tilt. And when value snapped back, we got it back with a vengeance. We had a 2% position in B of A, 2% position in Citi. Why? Because those companies were about 2% of the U.S. economy each. We had a 1% position in GM, because it was 1% of the U.S. economy. It went bust about 8 weeks later, and so the stock went to zero. But if one stock goes to zero and 2 other stocks triple, you're doing fine. So the shocking thing was that RAFI lagged the market in 2008 when value was getting crushed by 3%, and then outperformed in 2009 by 15%. So you got it back with a vengeance. And we see that happen again and again. Anytime I see RAFI underperform, I start to get excited because I know what happens next. We pivot into a deeper value tilt, and when value comes back, we get it back with a vengeance.
Now, to my understanding, RAFI refers to this fundamental approach, and we have many different ways this could be applied. So there's many different RAFI strategies. So maybe you could discuss what some of those strategies look like, how they're sort of constructed, and then how the positions are weighted in these RAFI strategies.
The purpose of RAFI is to be an economy-weighted index that weights companies according to their macroeconomic footprint. Now, when we walk on the beach, our footprint in the sand has multiple measures: length, width, depth of the footprint. Same thing is true for companies. Chevron has a fairly large footprint in terms of sales relative to all publicly traded companies. Fairly large on profits relative to all company profits. Very large on dividends relative to all company dividends. And pretty large on book value. Nvidia has a big economic footprint on profits, but not on sales. And so if there's any mean reversion to their monumental 53% profit margin, watch out. Book value, they're small. Dividends, well, they don't pay any. So you wind up with a company with good size economic footprint on one measure and a small footprint on 3 others. Net, pretty good size company. Certainly in the top 25, but not in the top 3. And Chevron reliably in the top 10. So you wind up with weightings that reflect the macroeconomy. Now, the way I like to think about this is if you weight the portfolio, if you choose stocks based on how big they are, the companies, and weight them on how big they are, you have a fundamental index. RAFI stands for Research Affiliates Fundamental Index. The cap-weighted market will take all the growth stocks with lofty expectations and say, these are great companies, I'm pricing them higher. So relative to the macroeconomy, the cap-weighted market is a growth-tilted, momentum-chasing popularity-weighted index. So I like to think of fundamental index as an economy-weighted index. You choose companies based on how big their business is. You weight companies on how big their business is. If the price rises and the fundamentals don't, you rebalance down. If the price tanks and the fundamentals stay solid, you rebalance up. So you're rebalancing against price moves that aren't supported by changes in the fundamentals. Now, the market is cap-weighted. So the cap-weighted indexes studiously mirror the look and composition of the market. Fundamental index, RAFI stands for Research Affiliates Fundamental Index. Fundamental index studiously mirrors the look and composition of the macroeconomy. Now, think of it this way. From the vantage point of cap-weighted indexers, this is not a passive strategy. This is an active, value-tilted strategy that contra-trades against price moves. Fair enough. Viewed from the perspective of fundamental index, the cap-weighted market is hardly passive. Cap-weighted market is making constant changes in what it believes the future will look like and where it believes the opportunities will lie. And so the cap-weighted market, from a fundamental perspective, is a growth-tilted, momentum-chasing, popularity-weighted index, which is going to work when trends are chasing popular ideas and can hurt you badly if those trends turn out to be a bubble.
Mm-hmm. So you put together this write-up on the equity risk premium and 9 myths related to that. So I wanted to touch on this article, but I think a good place to start here would be to talk about what is the equity risk premium and how do you think about calculating this metric?
Sure. And just in case your audience is curious, this was a paper that I wrote for the 50th anniversary edition of the Journal of Portfolio Management. The founding editor was a dear friend of mine, and when they had their 50th anniversary edition, he's long gone, sadly, but when they had their 50th anniversary edition, they reached out and asked if I'd like to contribute a paper. And a large chunk of the paper was focused on the equity risk premium. There's a lot of myths about the equity risk premium. People look at past differences in returns, stock returns versus bond returns, or stock returns versus cash returns. And they say that's the risk premium. No, that's the past historical excess return. That's a different beast entirely. The past historical excess return has a lot of constituent parts. Dividend yields versus bond or cash yields can be very different. The growth rate of earnings and dividends can be significant, and the growth rate of coupons on bonds, zero, by definition. So very different constituent parts to the returns, and a big part of the return can be revaluation. In the spring of 2009, the U.S. stock market hit bottom at 13 times the 10-year average earnings for the companies in the S&P or Russell Index. That's called a Shiller PE ratio of 13. Today, it's 3 times that. It's 38 times. So the stupendous run-up over the last 15 years is in large measure a consequence of rising valuation multiples of people being willing to pay more and more and more for every dollar of earnings. That's not risk premium. That's excess return. Risk premium is what your expected return is for stocks relative to bonds or cash. And if you want to be objective about it, you'd want to calculate today's risk premium by looking at differences. You've got a yield of close to 5% for cash. You've got a yield of 1.25% for stocks. Second lowest in history. Only the dot-com bubble had a lower dividend yield. And we know what happened after that. All right, well, that's a big difference, but surely you're going to see wonderful growth in earnings and dividends. Well, the consensus, according to Lipper, is 18% long-term growth in earnings and dividends. Pardon me, we're at a peak in earnings and dividends as a percentage of GDP, very near historic all-time highs, and you're expecting 18% growth? Are you expecting 18% GDP growth? I don't think so. If you're expecting 5% nominal, 2.5% real GDP growth, then 5% nominal growth in earnings or dividends ought to be a reasonable expectation, not 18. Now, you aren't going to get any growth from an income from bonds or cash. They're called fixed income for a reason. So, all right, you've got 1.25 yield, you've got 5% as a reasonable growth expectation. That gives you 6.25% return. Compare that with, call it 4.75 or 4.5 for U.S. cash, and you're looking at about a 1.5% risk premium for stocks. That's the risk premium. Now, people can have subjective views. That's also a risk premium, but it's subjective and it's based on whims and speculations and often some pretty shabby thought. There is an equity risk premium right now, but it's kind of skinny. So there's another component. I mentioned earlier that the rebound in valuation multiples since 2009 was stupendous. Shiller PE ratio tripled, dividend yields fell by 2/3. All right, well, that's a big change in what people will pay for every dollar of earnings or every dollar of dividends. People are willing to pay a lot. And so then the question is, where will that relative valuation be, let's say 10 years from now? We have a website. If people look up Asset Allocation Interactive, it's a free website where we forecast returns for upwards of 200 different asset classes. And our forecast for U.S. stocks is about 3.5%. I just took you through arithmetic that said 6.25. What's the difference? Well, let's assume that today's Shiller PE ratio is fair, and 10 years from now it's still 38 times. Then you get your 6.25%, give or take, because growth will be a little different from the 5, but not drastically. Let's suppose you get mean reversion. The historic norm is 18 to 20, and we think there's a new normal, that is to say, markets are sustainably more expensive than they used to be 30, 40, 50 years ago. So we think the normal is about low 20s, 23, let's say. If it falls from 38 to 23, that's going to cost you about 6% a year. Ouch. So let's split the difference. Let's say maybe it doesn't mean revert, or maybe it does. That takes away 3 and gets you to about 3.5. So that's the way we do our calculations of the risk premium. And on that basis, the equity risk premium today is modestly negative. How can you have a negative risk premium? Another part of that paper speculated on the idea that it's not a risk premium, it's a fear premium. It was mislabeled all along, which misled the quant community and the academic community for the last 60 years. It's a fear premium, and viewed from a fear perspective, back in 2009, people were afraid of equities because they'd just fallen by half. Today, people are afraid of cash because cash has been a useless asset. And so from today's perspective, the fear premium ought to be negative.
Yeah, I mean, one of the big takeaways for me from that article is to be mindful of this bias people have where they look at what happened the past 10 years and assume that that's what the next 10 years are going to look like. But, you know, these cycles play out into where after one stupendously good decade of ever expanding multiples, you know, you should be ready for some multiple contraction after that.
Yeah.
And one of
Were
the
the
myths,
90s followed by a stupendous decade? No. They were followed by a lost decade. Was the lost decade followed by another lost decade? No. It was followed by a stupendous decade. And so when you have a bull market that's taken us to valuation multiples that have only been seen once before in history, top of the dot-com bubble, you really ought to ratchet down your return expectations. I'm not saying be massively pessimistic and shun stocks forever. No, but do you really want to bet that this market's going to double when it could just as easily, or perhaps more easily, have a meaningful bear market? Personally, I'd like to have some margin of safety.
Hey everybody, it's Clay Fink here, host of We Study Billionaires. Here in a few months, Warren Buffett will be hosting the Woodstock for Capitalists in Omaha with the Berkshire Hathaway Annual Shareholders Meeting. The meeting welcomes over 40,000 investors that head to Omaha to tune into the marathon Q&A session with billionaire Warren Buffett and Berkshire managers. Since we don't know how much longer Buffett will be around to attract tens of thousands of people, I would highly encourage you to make the trip to Omaha during the first weekend of May. While I personally love sitting in on the meeting, what makes the trip extra special for me is the relationships that are built around the meeting, which is why I'd like to briefly tell you about the events that TIP will be hosting. My colleague Sean O'Malley will be hosting 2 free socials for the TIP audience on Friday and Saturday evening, and more details on that can be found in the link in the description below. And I'll be hosting a couple of dinners and socials for our TIP Mastermind community, which is our paid community for private investors, portfolio managers, and high net worth individuals. Attending the Berkshire meeting on your own can be quite a lonely experience, and I wanted to personally invite you to join the events that Sean and I will be hosting. Again, details on the free events can be found in the description below, and to apply to join our TIP Mastermind community, simply go to theinvestorspodcast.com/mastermind. That's theinvestorspodcast.com/mastermind. We'll also be sure to get that linked in the description as well. Additionally, flights and hotels can get booked quickly, so I'd encourage you to book yours as soon as possible if you plan on attending. And please feel free to email me or shoot me a message on LinkedIn if you have any questions. I would be more than happy to help. Hope to see you there. Buy low, sell high. It's easy to say, hard to do. For example, high interest rates are crushing the real estate market right now. Demand is dropping and prices are falling for many of the best assets. It's no wonder the Fundrise flagship fund plans to go on a buying spree, expanding its billion-dollar real estate portfolio over the next few months. You can add the Fundrise flagship fund to your portfolio in just minutes with as little as $10 by visiting fundrise.com/WSB. That's fundrise.com/WSB. Carefully consider the investment objectives, risks, charges, and expenses of the Fundrise flagship fund before investing. This and other information can be found in the fund's prospectus at fundrise.com/flagship. This is a paid advertisement. So one of the myths you highlighted in your article is that long-term forecasting is hard. How can it be that short-term forecasts, for example, 1 year, are largely unpredictable, but somehow longer-term forecasts, which are really just many 1 year strung together all into one, those are actually predictable? How does that work?
Long horizon forecasts, the long-term return of anything you invest in consists of what's the yield, what's the growth in income in the years ahead, and what's the change in valuation multiples, or in the case of bonds, what's the change in the spreads. And if you know those 3 numbers, you can estimate future returns with remarkable precision. For instance, 10-year returns for 10-year bonds, your best forecast is the starting yield. You're going to be within 1% either way. For the stock market, it's not as formulaic, but the starting yield plus long-term historical growth plus some mean reversion towards the past gets you a forecast that shockingly over the last 50 years would have been within 2 or 2.5% per annum of the actual stock market return most of the time. Well, that's pretty impressive. Now, the same dynamics play out in the coming year. The coming year, you've got yield. You know that. You've got growth with a lot more uncertainty, a lot more wiggle room. So yeah, the growth could be 5, but it could be 10 or it could be 0. So big uncertainty. And the revaluation component could be up 30% or down 30% relative to earnings. That's why the 1-year forecasts are very difficult. There's also the interesting issue that using long-term history can lead you astray. My favorite example is the second half of the 20th century. Now, a half century for any investor is a long term. Most of us die before our first 50 years of investing are wrapped up. And so 50 years is a long time. The stock market went from a dividend yield of 8 at the start of 1950 to a dividend yield of 1.1 at the end of 1999. Half a century, 7-fold change in the value attached to every dollar of dividends. Sevenfold change over the course of 50 years, that's 4% per annum. So that means that for a half century, your historical return had a biased picture of returns, hence risk premium, if you want to use the past to predict the future, 4% per annum. Pensions use a pension return assumption in determining what the pension impact on earnings per share is. And that pension return assumption can be somewhat subjective. At the beginning of 2000, the average pension return assumption was 9.5%. The highest in history, was never higher before, never higher after, and it was at a peak. So people were using past returns to say, oh, I can make it 9.5%. I have a balanced portfolio. My bonds are yielding 6. My stocks are going to give me 12. So I can assume 9.5 for my 60-40 portfolio. And lo and behold, stocks with a dividend yield of 1, to earn that 12% return assumption would have had to see growth of 11% a year and would have had to see no mean reversion in valuations. So of course the earnings didn't grow 11% a year, and of course there was mean reversion. So even long-term history can lead you astray. I've been stunned that in what's now a long career, going back 47 years, I've been pounding the drum on revaluation for a long time, for decades, as something that misleads us. And it's misleading us big time now because you have a tripling of valuation multiples in the last 15 years.
So it's, as you've alluded to earlier in the conversation, growth stocks have led the charge and really led to this big revaluation in the market overall. So when looking at, say, growth and value and where that disparity sits, like where are we at today in the cycle and how does that compare to past cycles?
Well, the short answer to your question is nobody knows where we are in that cycle. So I'm going to guess, and it is, I'll acknowledge, only a guess. My guess is that we're very near the bottom of a value cycle, and value today, just returning to historic norms, where value is normally about a fourth to a fifth as expensive as growth, would require value to double relative to growth stocks. Double. 10,000 basis points of incremental performance. Spread that over 10 years, and you have 20+% outperformance per year. Do I think we're going to see 20% outperformance per year over the next 10 years? No, I shaved that a bit. But I do think value could easily beat growth by 5, 6, 7% a year for the next 5 years, and therefore beat the market by 2 or 3% a year for the next 5 years. That's a big win, and I think that's a conservative forecast. Do I want to forecast that value will beat growth in 2025? Sure, but not with high confidence. I'd give it 60-40 odds on a next year basis, 40% chance of being dead wrong, and I'd give it at least 80-20 odds in the coming 10 years.
And when looking at how these cycles turn, does the market need some sort of catalyst to, spark this reversal, or do you need some sort of recession, or how do these cycles turn?
They often turn with a catalyst, but not always. I've asked the question, what was the catalyst that burst the dot-com bubble other than gravity? Things were too high. I've heard a lot of answers, but none that were totally satisfying as something that could cause a complete crash of growth stocks. And so I think it was overwhelmingly just gravity. But usually there's a catalyst, and the funny thing about catalysts is that by definition they're a surprise. If it's not a surprise, it's not a catalyst. So it's kind of a fun parlor game to ask the question, what could be the catalyst? One catalyst could be mean reversion in valuations, which is another way of saying gravity. Another catalyst could be a slowdown in the economy in which growth stocks mean revert towards value stocks in relative valuation. Another catalyst could be very similar to the dot-com bubble and burst. In the dot-com bubble, the narrative was These companies are building a new future. They're creating the internet, and the internet's going to be huge. It'll change how we buy and sell goods and services. It'll change how we communicate with our clients and with our friends. It'll change how we socially interact. It'll change how we get our news. All true. Narratives have the advantage of being mostly true. What wasn't true was the narrative went on to say this is going to happen astonishingly fast, and these companies are going to be the leaders 10 years from now, too. And disruptors get disrupted. Palm was briefly worth more than General Motors in 2000. Does anyone have a Palm Pilot anymore? Does anyone have anything that vaguely resembles a Palm Pilot or is made by the company anymore? Of course not. BlackBerry was already on the scene, and BlackBerry went on to have dominant market share in handheld devices by 2008 and 9. And then the iPhone, which came along in 2007, disrupted BlackBerry. So you had sequential disruptions. Google disrupted other search engines. Ask Jeeves, remember Ask Jeeves? So the whole notion that these companies have a lock on the future is dangerous. Disruptors get disrupted. The whole notion that the world will embrace AI fast is a little dangerous. AI is going to be huge, but it's going to take time because people embrace change slowly. Luddites will want to slow it down, but its very nature will be to happen fast, but human nature is to embrace change slowly. So I'm guessing, just like the internet, 2005 was very similar to 2000 in the way we all behaved. 2024 is very different. And the same thing will happen with AI. I think 5 years from now, it'll be making noticeable strides, but it's not going to be an unrecognizable world. 2050 might be an unrecognizable world to those of us here today.
Yeah, I mean, when I look at through much of the 2010s and the later 2010s, many people would justify, higher stock prices simply by just looking at bond yields and how low bond yields were. So it's like, hey, if the S&P 500 is paying a 2 or 2.5% yield and the bond yield's 1 or 2%, then I'll take the S&P 500 all day. It was how a lot of people justified that. And what's sort of taken me by surprise is just how strong the market's been after interest rates have come up. So that justification just sort of goes out the window. It seems to me that in your view, what's led a lot of this market rally is just this narrative around AI. Is that really how you characterize it?
There's that. There's also the political effect. A lot of people think that reducing the burden of regulatory overreach may be in the cards. I'm skeptical that Trump or Doge will get much of their wish list done, but one can always hope. The other political element that's a fun one, I wrote a paper 8 weeks before the election in which I showed that with contentious elections, the stock market rallies from a few days before the election for the next 4 to 6 weeks. No matter who wins, it doesn't matter who wins. I had a billionaire client in 2004, very recognizable name, who was a big donor to Democrats. And he came to me just a few weeks before the election, and he said, I'm getting scared. I think GW could win. And I want to pull out. I want to get out of the stock market. And my comment to him was, there's people on both sides who feel that way. There are some who think, oh my God, Kerry might win. I want to get out of the market. And when the election happens, one side or the other is relieved. And the ones who were so alarmed that they got out of the market are coming back in. So my suggestion is, wait. No matter who wins, I predict the market will go up. And 6-8 weeks after the election, let's have another conversation. If you want out, let's take you out. And 6 or 8 weeks after the election, he said, never mind. But the bottom line is that's a fairly persistent pattern. And it's kind of a fun one. No matter where you sit politically, somebody on the other side of the spectrum shares your sense of alarm about what's coming. I mean, every election is portrayed as the most consequential of our lifetimes. And every election that's ever happened, the country's survived just fine over the next 4 years. So rather than being alarmed, look for opportunities. It's kind of fun.
Mm-hmm. I wanted to get to Nixed, but I had one more comment I wanted to make here because I thought it was just so interesting. I was tuning into one of your previous conversations and you were discussing Nvidia, which we've already touched on today. And one of your comments that I loved regarding Nvidia was, I don't have a problem with 70 times earnings. I have a problem with 40 times sales. 40 times sales is very hard to justify, which I thought was quite interesting because so many investors are so anchored to, what is the company earning today? What's that earnings going to look like into the future? And I believe you also said the Achilles heel for Nvidia is going to be compressed margins, not revenue growth. They're going to be a great business going forward. Is just like, how much margin are they going to be able to get? I was curious if you could talk more about that.
Sure. The narrative about Nvidia is this company is changing the world, and it is. This company dominates the super chips market that in turn dominates AI. 100 billion annual sales, 60 billion annual profits. That's phenomenal. But the narrative is AI is going to be a big part of our future. The sales are going to keep soaring. Yeah, absolutely true. If you model it out and if you assume, let's say 30% growth in sales per annum compounded for the next decade, are the competitors going to sit on their hands? I don't think so. Is the price going to stay 40,000 per chip? I don't think so. So let's speculate on a future where the unit growth is 30% a year, but instead of 90% market share, they got 40% in 10 years. Instead of 53% profit margin like they had last quarter, they're down to 30% profit margin. Plug those numbers in, and what you find is that the earnings in 2034 are almost identical to the earnings in 2024. Now, that's shocking. But it's shocking to people who haven't thought about it in those terms. And the simple fact is, often bubbles are blown based not on a flawed narrative, but on narrative overreach, where you assume that your narrative is not only true, but going to happen unaltered. The competition is not sitting on their hands. AMD already has chips that are as fast as NVIDIA's fastest. Why don't people switch? Because the price is 1/3 as much. They don't switch because you got to reprogram everything. And so switching is not easy. But switching can happen over the course of 2, 3, 5 years. And so I look on NVIDIA as a beautiful company with a great vision, and Huang was an absolute genius in saying these super chips that we're about to build, let's leave some dead real estate on them for future innovations. And his team pushed back and said, what are you talking about? That's a waste. And he said, no, we're going to need it. And sure enough, the innovations filled in that space, and they were instantly the dominant player in super chips. Well, that's very cool. And AI is very cool. Anyone who's played around with the AI tools, AI has been around forever. I was doing neural nets in the 1980s, but they weren't very useful back then because the compute power wasn't large and the data, you need massive data. The new phenomenon is user-friendly AI. And the AI that's at our disposal now, average person doesn't have to be a nerd. You can just pose a question to ChatGPT. You can say, I want some graphic arts to DALL-E, and describe roughly what you want, and it'll spit out 10 images that are interesting. It's going to change our world. But the leaders of today won't necessarily be the leaders of tomorrow, and they will have competition. There will be price compression.
Yeah, it's also quite humbling to look back at 1999 and see what many of the big companies were then, who the market darlings were, and how those stocks favored over the next 10, 20 years. So I wanted to be sure to get to your write-up on Nixed, the upside of getting dumped. So it's often said that a benefit of index investing is that by owning the index, you're automatically adding to the winners and cutting your losers. And being the contrarian that you are, you're interested in even looking at the opposite, looking at the losing stocks that get removed and are ignored by the market, and turning away from the winning stocks that replace the companies that get dropped out of the index and actually tend to not favor as well. So Please walk us through your research on Nixed.
Sure. Well, firstly, the title is obviously a whimsical one, The Upside of Getting Dumped. I'm reasonably sure you've never experienced getting dumped, but I have, and most of us have. If you get dumped, you can wallow in self-pity for life, or you could pull your socks up and move forward and learn lessons and seek to do better next time. Okay, companies can do the same thing. If a company gets dumped from the S&P, it's a troubled company. It's out of favor. It's unloved. It's cheap. And it may, I like to joke, it may go on to achieve great failure. Or it may get its act together, and it's not priced for that. It's priced for continued struggles and perhaps oblivion. We created the index, Nixed, in end of June. And the goal is to find stocks dropped from the largest 500, very similar to the S&P, and the largest 1,000, very similar to the Russell 1000. We did research on those two indexes, and we found that the stocks dropped by those indexes on average outperformed by 28%, 2,800 basis points over the next 5 years. That's a big margin of victory. It doesn't matter whether you use S&P or Russell or a filter of top 500 and top 1,000. The mechanism for dropping a stock is the same. It's out of favor. It's plunged in valuation multiples. It's plunged out of your target market cap range and is replaced with a frothy high flyer. And so we launched the index in end of June. There's a stock, Lumen, that was dropped by the S&P in, I believe, April of 2023, dropped by the Russell index in June of 2023, and signed a major contract with Meta about 8, 10, 12 weeks ago to help Meta beef up their AI capabilities. So the stock is up 550% since June. Well, that's pretty cool. Now, the stocks, we hold stocks for 5 years. Why? Because it's a persistent trend. It slows during the 5 years. I mean, it starts out 7% a year, and then it's 2 or 3% a year. And so we give it up after 5 years. Stocks deleted over the last 5 years from the top 500 or top 1,000, there's 150 of them. And we equally weight them. So basically, we're playing a game not unlike fundamental index. These companies tumble in market cap, market value, but they're still not small companies. And the result is a fundamental index chooses companies based on how big the business is and then weights them on how big the business is. Cap weighting doesn't matter the size of the business. If it's out of favor and unloved and dirt cheap, it's gone. So when we look at the 150 names, Lumen was one of them. And that single stock has given us over 200 basis points of alpha because it's quadrupled as a share of the index in just a few weeks. That's cool. That's fun. And you don't need a lot of examples like that out of 150 names. It's not the only one that's more than doubled, but there aren't many. And so you just need a handful of companies that regain their footing to beat small cap value, which is the appropriate benchmark for Nixed. ETF Architects is a company that launches ETFs, and they launched an ETF based on the Nixed index back in early September. And it's still small, but it's a very powerful way to access a part of the market that has no natural owners. Index funds have dumped it. Index funds, when they sell, they have to sell to active managers. Active managers don't like these companies. That's why they're cheap. So they have to sell to companies that active managers who don't want it. And so exits the index abnormally cheap. And that's part of what sets the stage for the subsequent tendency for outperformance. It wins historically, testing it back over the last 30 years, it wins about half of the time, 15 out of 30 years, give or take. But when it loses by about 5%, and when it wins by about 18%. That's an asymmetry that I love.
Mm-hmm. And I want to ask you about a few numbers if you happen to know them. So first, I'm curious, of a company that's in the S&P 500, what amount of the shares are held by the index? And then my second question is, when a company gets added to the S&P 500, what sort of boost Does it get to the multiple?
We've documented this again and again. I did a paper back in 1986 entitled S&P Additions and Deletions, a Market Anomaly. And my understanding is that S&P actually used that paper, or S&P indexers used that paper to lobby S&P to pre-announce additions and deletions, which they started doing in October of 1989. But in that paper, I showed that additions outperform in the immediate aftermath of being added by 5% or more, and deletions underperform by 5% or more. Might not have been 5 each way. I think the total gap was about 8. The gap by 2017 was now 16%. So additions win and deletions lose by about 16% relative to one another. So that stretching of the rubber band snaps back in the aftermath. And that's a beautiful thing. So the 2017 paper, Buy High and Sell Low with Index Funds, pointed out, firstly, that when you buy in an index fund, typically you're going to be buying a frothy company that's expensive, and your buying pressure will push it higher. If you sell, get rid of a company, typically your selling pressure will push it lower. And that gap is about 16%. Now, indexes do most of their trading in a single block trade on the change date, the effective date. Why? Because they've trained the world to see tracking error relative to the index as a sign of incompetence. So even if the tracking error is positive, shame on you. It could work negatively next time. So you're clearly not competent. So they are much more interested in locking in the exact price at which it's added or dropped from the index. Back in 1986, they couldn't do that. It was not pre-announced. It was announced typically on a Wednesday right after the market closed, and the effective price was the one that had just closed. All right, so that meant index funds moved the prices and therefore underperformed the indexes that they were tracking and lobbied aggressively, come on guys, pre-announce this so that we don't have to underperform. And these days, some of them say, see, we don't move prices. No, they do. Not they themselves, but the hedge funds that front run those trades and then flip the stocks to the index funds. They're leaving money on the table, quite a bit of money. So the process of adding and dropping companies is a big deal. It's getting bigger and bigger because index funds are getting bigger and bigger. I don't have the number for your first question, how big are indexes as a share of market cap. I think it's in the ballpark for S&P 500. I think they own somewhere in the ballpark of 25% of the total market cap of every stock in the S&P 500, and of course 0 of every stock that's not. So if a stock is added to the index, they have to go from 0 to own 25% of the total market cap of the company. And if it's dropped, they have to go from owning 25% to owning 0. A lot of them will want to do that trade in a market on close block trade on the effective date to lock in exact matching of the index. And they don't care if hedge funds have pushed the price up on the addition or pushed the price down on the deletion because they're trying to lock in 0 tracking error. Well, that's too bad. The 2017 paper, we posed a really simple question. What happens if S&P makes a change? You write it on a Post-it note, you stick it on your fridge, and a year later you do the trade. You wind up with 20 basis points higher returns than the S&P because you don't participate in that huge melt up in price and melt down in price on the deletions. Well, Nixed captures one side of that, and RAFI captures both sides of that because you own companies. You're going to add a company long after a cap-weighted index adds it because a cap-weighted index will add it when it's frothy, expensive, popular, beloved, but still a small company. And RAFI will add it when it's proven its merit and is now a big company. Deletions. Stocks get kicked out of the cap-weighted index before they're small companies when they're small cap, and get kicked out of RAFI after they're no longer big companies. So the turnover associated with additions and deletions is lower for RAFI than it is for cap weight. There is a rebalancing component that adds back into the turnover, but one of the beauties of all of this work, it's all interconnected. There are vulnerabilities in the way cap weighting works, and that's not to say cap weighting is a bad idea. If you want to own the market and you want to make no bets on cap weight, that's totally fine. We've actually introduced a new version of cap-weighted indexing called RACWI, Research Affiliates Cap-Weighted Index, which takes the RAFI universe and cap-weights it. Has lower turnover than conventional cap-weighted indexes and historically adds about 50 basis points. That's pretty cool.
Many people are probably tired of me or us discussing the S&P 500, but it's just so popular for people to talk about. I had a question related to the S&P 500 is that many people see this as, just a passive approach to investing in the market. But at the end of the day, somebody has to select what companies are versus aren't included in the S&P 500. I was curious if you could just talk about what that process typically looks like for an index like that.
For the Russell 1000, the process is formulaic. I think if it gets into the top 900 by float or out of the top 1100 by float, it's added or dropped. Something like that. For S&P, it's a committee decision. Tesla's a beautiful example. March of 2020, people started to speculate that Tesla, which had just finished its third profitable quarter in a row, it had been unprofitable quarter by quarter, year by year, since inception. And suddenly it was profitable for 3 quarters in a row, and they knew that S&P wouldn't add it without 4 profitable quarters in a row. And so people in March began to say, wow, this is about to be added, and it's big. So people started buying it. Fourth quarter profits is reported. S&P is kind of paralyzed. They aren't sure what they want to do. And fifth quarter comes along, pressure's intense. They've got to do something. And so they decide to add it in one fell swoop in December of 2020. Well, between the decision date, which was late November, and the addition date, which was mid-December, the stock was up well over 40%. But roll the clock back to March, it was up something like 250%. All on the back of not fundamentals shocking to the upside, although they were showing an ability to turn a profit, which is cool. But based on the narrative that this stock is going to get added and there's going to be a 25% of its total market cap is going to have to change hands in one fell swoop. And so I'm not critical of S&P's methodology. I'm not critical of Russell's methodology. I would say that the cap-weighted indexes claim to be passive. People think of them as passive. They are passive. When a stock's in the index, it stays there, and its weight in the index moves up and down with price. And the only thing that'll change that is if there's new shares issued or a stock buyback. But basically, it's passive, except at the bottom of the list where stocks are added and dropped. And there it's very active with massive trading costs. And thank God the turnover is so low, because those massive trading costs are multiplied by 3 to 5% turnover, which is tiny. So it costs tens of basis points, and you can recapture that. You can recapture that by trading late. You can recapture that by constructing the index in a different way. So indexes are a wonderful thing in terms of allowing you to be a free rider. Let the market do price discovery for you. Let the market decide where to allocate capital. And you just piggyback along and pay almost nothing. Well, that's kind of cool. But on the other hand, it's not without its vulnerabilities, and it does leave a rebalancing alpha on the table, which RAFI captures. And it does add frothy stocks and drop on love stocks, which RACWI captures and Nixed captures. So these are all kind of interconnected. It's fun stuff.
Mm-hmm. Well, Rob, this was a fun chat. I really appreciate you coming on the show and uncovering just these interesting strategies with the fundamental index and Nixed. I want to give you a chance to give a handoff to the audience if they'd like to learn more about you and Research Affiliates and everything you guys are up to.
Well, firstly, if you go to our website, there's a ton of information. We've written, I'm going to scare your audience off. We've written 400 journal articles in the last 25 years. Some of them are very, very good. And a lot of that is readily accessible. We have Asset Allocation Interactive, which is an interactive tool that helps you look at multiple asset classes around the world and ask, where's the opportunity? Spoiler alert, the opportunity is not so much in U.S. large cap growth stocks or in mainstream U.S. bonds and cash. Those are priced to give you, call it 3 to 5% returns. If you want good returns, it's an opportunity-rich environment because there are markets that are priced really pretty cheap all over the world. They're just not U.S. stocks and bonds. So U.S. value looks pretty good. Small cap looks pretty good. Small cap value looks very good. And international stocks and emerging market stocks look pretty good. Well, aren't I aware that international and emerging markets have fallen far behind the U.S.? Yeah, that's why they're cheap.
Alrighty, Rob. Well, thanks again. Really appreciate the opportunity and hope we can do it again sometime in the future.
This was fun. Thanks for the invitation.
To gauge the temperature of the market, Howard looks at both the quantitative and the qualitative. The quantitative being the valuation metrics of whatever asset class he's looking at, and the qualitative is being aware of his environment and how other investors are behaving. And again, he isn't forecasting. No matter where you're at in the cycle, the market